I'm Darius McDermott from Fund Caliber, and I'm delighted to be joined today by Job Curtis, who runs the City of London Investment Trust. Job, good morning.
Good morning.
So you're one of these unique managers in a lot of ways, because you've been managing this trust for 30 years, which is a huge length of time. So congratulations on that. But I suppose you must have gained an awful lot of experience. We've had so many different market conditions during that period. How did you find 2020? Was it an opportune year, or was it just very stressful?
Well, one of the interesting aspects of the job is that you know it's always very different, and you can go through cycles, but there are always unexpected things. And obviously, 2020 with a pandemic and the lockdown of the economy is not something I'd experienced before. I mean, it's part of the job, and my role is to sort of manage people's investments through whatever conditions there are in markets. Sometimes it can be dangerous when the market's going up. You can get complacent, so that is you've got to be as observant in those conditions as you are in the very difficult months we had last year. So it's part of the job, and I find it very interesting.
Yeah. So another big thing which happened in 2020, of course, was dividends and cuts to dividends, whereas your trust is categorized as a dividend hero by the Association of Investment Companies, the trade body. You've increased your dividends now for a vast number of years. How do you manage to do that?
Well, we have the longest record of any investment trust for dividend growth, 54 consecutive years.
Wow, 54 years, that's fantastic.
Well, thank you. It's obviously, you need to be in good companies, have a core of your portfolio being good companies, but you also, investment trusts do have a specific advantage in terms of dividend increases, and that they can use something called revenue reserves. So we don't have to distribute all our income in any one year. So in the good years, we hold back up to 15%, and that builds up into revenue reserve. And so in the difficult years for dividends, we can dig into that reserve and carry on growing our dividend. And this is what we did for 2020, when also there were a lot of dividend cuts across the market. And as a result, our revenues suffered from those dividend cuts, and we were able to use revenue reserves to continue growing our dividend. We've done that. Of the 29 years I've been manager, we're about to hit 30 years. Of the 29 years, we've done that eight times. The other 21 times we've added to revenue reserves.
And how many of your good companies had to actually cut their dividends last year? Because some dividend cuts were enforced by regulators or government. How did your portfolio come through that?
Well, our portfolio fared better than the market overall, but the cuts across the market were very severe, and the FTSE All-Share dividends were down some 38% in 2020. And it was certainly, we had a lot of dividend cuts during the financial crisis, but this was more severe, and it was also so concentrated. It happened in a few months. Some of them, as you say, were such as the banks were called for by the regulators. They stopped the dividends, but others, in other situations, companies just were in no position to pay dividends, such as travel and leisure companies where their business had been shut down. And there were other companies where maybe under the smokescreen of all the dividend cuts, it was an opportunity to reset their dividends, where they've been kind of over generous on distribution in the past.
Yeah, no, and I think maybe history will show that some of those resetting of dividends was probably a good thing for companies that were over distributing. So let's look forward as we sort of come out of the pandemic. Some UK businesses are actually in quite good health, have increased their sort of revenues. What are you seeing from UK companies? And as you say, you'd like to invest in good companies that have cash flow, can hence pay you your dividend. What are you seeing in the market? Do you think we'll see more dividends, or do you think sort of companies will look to sort of reinvest?
Well, I think there has been a terrific recovery from the lows of the dividends cuts, which was sort of around kind of May of last year. And, a lot of companies have come back to the dividend list. I mean, some sectors are more deeply scarred, such as travel and leisure, which are, barely reopening even now, and the companies are less able, not such a strong position to pay dividends. But in general, growth is picking up very strongly across the economy. Obviously, there's been a huge amount of support from both the central banks and the governments with a lot of extra government spending, and this has helped the economy get through this period. And now with the reopening we're seeing both in the UK and overseas, companies are in a much better position to grow and carry on increasing their dividends. I mean, some companies sailed through this very strongly and through the whole period, but there are other areas where inevitably they suffered for a period and are now recovering.
Great. So just looking through the trust, I see you have quite a lot of financial companies at the moment. Would you talk to us a little bit about the different types of financial companies that you own and what it is that you like about them currently?
Well, I think financial services is something we in the UK do very well, and in particular, the areas where we particularly got quite large positions relative to the market averages are in insurance and life insurance and diversified financials. And there's some excellent companies, and the undervaluation in that area of the market was rather highlighted to me by when RSA, which was an old British insurance company, was bid for by a combination of a Scandinavian and a Canadian insurance company in combination, and they were issuing their own shares, which were much more highly rated, to buy the lowly rated RSA. We didn't actually hold RSA in our portfolio, but we think that was a good example of the sort of undervaluation that you can find in the UK market. And certainly, there's a very attractive combination of yield and capital appreciation prospects in those areas of the market. So the holdings that we've got in the portfolio, in our view.
Well, maybe that's a lovely segue in then to my final question, which is the state of the UK market. You talked briefly about undervalued opportunities, but the word of the week, particularly given the recent Morrison's bid, is mergers and acquisitions, M&A. This is definitely picking up on the UK stock market. Have you got any observations about that? And do you hold any of the target stocks or things that you think might become attractive to a merger and acquisition?
Well, yes, the UK market, in my view, has become quite undervalued. And the fact that we're seeing a lot of takeover activity is an example, that other people are seeing this value. I mean, I think we've become undervalued because, whether we like it or not, Brexit globally is seen as a negative. And I think global investors have turned their attention away from the UK. Of course, UK is full of tech stocks, and so we haven't, and they've really led the markets in recent years. So in our market, it's really been quite left behind, and it's meant that that there is value there, and we actually have Morrison's and City of London's portfolio, and I think that's a good example. I mean, the shares have barely moved over the last 12 months, and yet the company, it's a very interesting supermarket group. Actually, it owns a very high percentage of its own stores, over 80%. It also sources a lot of its food from local farms. It's got the highest percentage of kind of local sourcing of all the supermarkets. It's got a strong balance sheet, and it's also got a growing relationship with Amazon. If you buy groceries off Amazon in the UK, you'll probably find that source from Morrison. So it's an interesting company, very much overlooked, and there's been a 35% rise in the share price since the news broke, but it certainly is a good holding for City of London, and one that I think even after the move we've seen still looks very good value.
Job, thank you very much for your time. I think your observation is absolutely spot on. The UK has been unloved by certainly overseas investors, and I think some domestic investors as well. And the pickup in M&A is a trigger or a sign that maybe there is good value in the UK. So if you'd like to get some more information on the City of London Investment Trust, please visit fundcalibre.com.